In this video, we'll walk through the cash conversion cycle for Kroger and Tiffany. The cash conversion cycle is a method of measuring how long cash is tied up in operating working capital. It's measured in terms of days, and all it gives you is just a back of the envelope estimation of the inherent delays in converting uh, uh, inventory into accounts receivable and then into actual cash dollars. All right, the concept behind the cash conversion cycle is a firm first purchases inventory, sits it on the shelf, and holds it for sale. When it sells it, if it sells it and takes an accounts receivable, it still has money tied up. When it originally purchased the inventory, that costs money, and then when they sell it to another customer, they're giving away the inventory, but they're taking an IOU. So after the end of those two periods, they receive their dollar bill. Now, offsetting that is the fact that most firms purchase inventory or the raw materials that go into making their inventory on credit. So when you look at the entire cash conversion cycle, it's basically how long the material stays on the shelf, that's days of inventory. Add to that how long money sits in accounts receivable before the firm's paid, and then subtract from that how long the firm delays paying their own suppliers. That's the cash conversion cycle. Days of inventory, also called the inventory conversion period, is simply the amount of inventory divided by 1 day's worth of cost of goods sold. And 1 day's cost of goods sold measures the how much cost of goods sold that you produce per day. And so inventory divided by that would give you the days of inventory. Similarly, accounts receivable divided by 1 day's worth of revenue gives you how many days worth of sales are tied up in accounts receivable. And finally, the days of payables, that's accounts payable divided by 1 day's cost of goods sold. That's also called the accounts payable deferral period. The days of inventory plus the days of receivables and then subtract the days of payables gives you the cash conversion cycle. And there's no right or wrong number on there. Again, you want to look for changes in the cash conversion cycle, and if it's getting longer, you want to know why. Is it because inventory's on the shelf longer? Is it that we're extending more credit? Is it that we're paying off our accounts payable faster? All right, let's flip over and go through the calculations using the numbers from Kroger's. If I calculate days of inventory, that would be inventory divided by 1 day's cost of goods sold. So inventory sits on the shelf roughly 26 days in the period ending January 2014. Days of receivables, accounts receivable divided by revenue divided by 365. So roughly 30 and a half days between purchasing the inventory and actually receiving a dollar from a customer who purchased the inventory from you. And that's offset by the accounts payable divided by 1 day's cost of goods sold. So while it takes about 30 days or about a month for Kroger to convert the inventory into a dollar bill, they take about 3 weeks to pay for the inventory that they purchased. So if we look at the cash conversion cycle, days of inventory plus days of receivables minus the days of payables, and we get roughly a week's worth of cash tied up. We look at how this has changed over time. The days of inventory, they've been improving the efficiency that they turn over inventory. The days of receivables have stayed roughly the same. The days of payables has actually gone down a little bit. So when we see their cash conversion cycle dropping from 10 to 8 to 7 and then going back up slightly, now we can see why. It's slightly faster conversion of the inventory, but they're also offsetting that by paying their suppliers a little bit faster. Still, that's a fairly stable cash conversion cycle, runs roughly 8 days. If we copy all this over to Tiffany's, the days of inventory was 445 days. This is over a year, right? I mean by that it's longer than a year's worth of inventory, and that just has increased somewhat in these last 3 years. We can see the receivables have gone down, so they're collecting a little bit faster on their receivables. We don't have any payables here, and that might be an accounting anomaly or a way that Morningstar put together the data, but generally speaking, we'll see that looks like a year and a half's worth of cash tied up in the cash conversion cycle.